We've already covered what dividend tax and capital gains tax are in previous videos, which you can find by clicking the links up here. But now we're going to take you through how to use clever financial planning to reduce your tax bill. The first step is to use up your annual tax-free limits. For capital gains tax, or CGT, this means cashing in some investments to realise the gain up to the current annual limit. Just be careful if you intend to buy the same holding back outside of an ISA or self-invested personal pension, also known as a SIP. If you do this within 30 days, then you'll be deemed to have bought it back at the original cost and not realised any gains. This tax avoidance rule is sometimes known as the bed and breakfast rule. The second step is to move the investment to your spouse or civil partner, assuming they haven't used up their tax-free amounts. These transfers are exempt from CGT and there's no limit to how many investments you can transfer. You can benefit in two ways from this. Transferring an asset and selling it up in the case of CGT would use up your spouse's tax-free amounts, or if your spouse is in a lower income tax bracket than you could pay CGT or dividend tax at a lower rate. You just need to make sure that you keep a note of the original cost of the asset, as that's what will be used when your partner comes to sell it. The third step is to use ISAs and SIPs. Anything inside these wrappers won't be subject to capital gains or dividend tax. The ISA allowance is £20,000 per tax year across all types of ISA per person, and for most people the pension limit is £40,000 a year. So if you've not already maxed it out, you can use up these allowances. If you want to make the most of your allowances and keep the same investments, then you might consider a bed and ISA transaction. This involves selling an investment and using the cash proceeds to buy it back within the ISA as quickly as possible. There might be some stamp duty and dealing costs to pay, but any gains and dividends going forward will be completely tax-free. You can find more out about bed and ISAs on the AJ Bell website. While no investor wants to make a loss, losses can be your friend for capital gains tax purposes. Losses made in the current tax year can be offset against any gains before you deduct the annual tax-free allowance. If you don't use them this year, you can carry forward any losses for future tax years to offset against any future gains. Just make sure you register the losses with HMRC within 4 years after the end of the tax year in which you made the sale in question. And finally, the fifth trick to reduce your tax bill is to use pension contributions to reduce your income tax band. When you contribute to your pension, the gross value of the contribution has the effect of extending your basic rate tax band. This means that the rate of CGT and dividend tax you pay could be lower if it means you're no longer a higher rate taxpayer. If you've used your pension allowances or cannot make a pension contribution, you can also lower your taxable income by donating to charity. You can claim gift aid on the donation if you're eligible. Thanks for watching, and we hope this has been helpful.